3 beginner crypto trading strategies worth exploring. Trading crypto assets without having a strategy in place typically results in a loss of the amount that was invested. This is because crypto assets are a high-risk investment. Even while most market experts would agree that there is no such thing as a perfect trading technique, experienced traders have identified 3 approaches that work very well for beginner investors. Hey everyone, welcome to our channel. Today, we will look at 3 beginner crypto trading strategies that are worth exploring. Disclaimer, I'm not a financial advisor. The video is for informational and educational purposes only. So, let's dig right into it. Strategy number 1. Dollar cost averaging, or DCA. Dollar cost averaging is a popular and well-proven trading method that performs well over longer time periods. The idea is straightforward. Instead of investing all of your money in one cryptocurrency at once, divide it into little sums and buy just at certain times and days of the week. For instance, suppose Bob has $10,000 to invest in Bitcoin. Instead of spending the entire $10,000 all at once, he decides to utilize the DCA approach and divide it into 20 lots of $500. He then selects a specific day and time to acquire Bitcoin, such as Monday at 12 p.m. local time. Bob will buy $500 worth of Bitcoin every Monday at midday for the following 20 weeks until he has invested his full $10,000. Buying at regular intervals like this over a lengthy period of time helps to decrease the impact of market volatility, when prices increase and fall abruptly, and means Bob will likely get more Bitcoin for his money on average than if he spent all of his money at once. DCA BTC, a Bitcoin-specific DCA calculator, demonstrates this in deeper depth. If you spend $150 on Bitcoin every Monday beginning January 1, 2018, you would have spent $23,550 and have 3.04 Bitcoin. If you had paid $23,550 on Bitcoin on January 1, 2018, you would have received 1.69 Bitcoin. Another reason dollar cost averaging is a suitable crypto trading approach for beginners is that it can be fully automated using a variety of different trading bot services, such as CryptoHopper, CoinRule, or 3Commas. This implies that all you have to do is deposit funds, tell the trading bot what you want to trade and when you want to trade it, and let it do the rest. If you choose to conduct the DCA approach manually, purchasing the crypto on an exchange at predetermined intervals, you can boost your overall results by following one easy rule. Only buy the specific crypto asset at predetermined intervals when prices are in the red. This occurs when an asset's price is lower than it was 24 hours ago. Strategy number 2. Golden Cross/Death Cross. The Golden Cross/Death Cross crypto trading strategy employs 2 moving averages, or MAs, which are chart indicator lines that reflect the mean average price of an asset over a specified period. Over long chart timeframes, such as daily and weekly charts, you are looking for crosses between the 50 MA, an average of the previous 50 days, and the 200 MA, an average of the previous 200 days. This is another long-term trading method that works best over 18 months and beyond because it deals with analyzing price action over long time periods. You're looking for 2 kinds of crossovers. When the 50 MA crosses above the 200 MA, this is referred to as convergence or golden cross. Divergence or death cross occurs when the 50 MA falls below the 200 MA. Convergences indicate that short-term momentum has surpassed long-term momentum, which is a buy indication. This occurs when buyers return to the market, driving up prices. Divergences indicate the reverse, that short-term momentum is declining relative to long-term momentum. This is a sell signal. Divergences occur when a substantial number of traders decide to withdraw from the market and sell their assets. To do so, log into your online charting tool account, such as TradingView, and alter the time period, red arrow, to daily or weekly, red box. Then click the Indicators button, blue arrow, and search for moving averages. To add 2 moving averages, click twice. The moving average settings must then be changed by clicking on the cog icon of each moving average in the top left-hand corner and changing the length, or red arrow, to 50 and 200 respectively. You can also modify the colors, blue arrow, to distinguish between the 2 lines by clicking on Style. It's worth noting that this crypto trading strategy works best in a tumultuous market, when prices are rising or falling sharply. When the market goes sideways, the 2 moving average lines converge and diverge more frequently, resulting in many buy and sell signals. This usually occurs when the market is volatile and there are an equal number of negative and bullish traders. This is the trading strategy's single flaw. However, the average gains tend to surpass any losses experienced during periods of low volatility. Again, this is a long-term technique that works best over a minimum of 18 months and can be paired with other indicators to provide greater outcomes. Strategy number 3. RSI Divergence Crypto Trading Strategy. The RSI divergence approach is a more technical strategy that can be used to predict trend reversals before they occur. This is the point at which the price begins to move in the opposite direction, from a downward to an uptrend or vice versa. RSI is an abbreviation for Relative Strength Index, a chart indicator that monitors momentum by calculating the average number of gains and losses over a 14-day period. The indicator line oscillates between 0 and 100, indicating when an item has been overbought or oversold. This is most typically displayed on a channel between 30 and 70. When the indicator line breaks out of the channel over 70, the asset is termed overbought and the price is expected to fall. When the asset breaks through the bottom of the channel below 30, it is considered oversold, implying that the price will likely rise. While this approach can be utilized as a simple crypto trading strategy on its own, it can occasionally produce incorrect outcomes. For example, when the RSI indicates that an asset is overbought, which is normally a buy indication, the price drops even further. The RSI divergence approach is more advanced and can be used to predict when the price trend will change direction before it occurs. It searches for differences between the price and the RSI indicator. In most cases, the price and the RSI move in the same direction. However, there are situations when the price drops while the RSI rises and vice versa. This only occurs when there is a small shift in buying or selling volume and is a warning sign that momentum is about to reverse. The optimum times to check for divergences are usually within a 4-hour or daily time frame. These time spans typically exhibit more pronounced variations in the mid to long-term trend. The chart below shows 3 important RSI divergences on the recent Bitcoin/US dollar chart, BTC/USD, that foretold shifts in the broader trend. The yellow lines represent the price and RSI indicator divergences. Divergences are most likely to appear when the price is either oversold or overbought. This approach can also be used to detect tiny changes in a trend, such as detecting a pullback in a downward trend. Looking more closely at the circular area, white, on the 30-minute chart, we can observe another divergence indicating that momentum was shifting back to positive. So, what's your favorite crypto trading strategy? Please let us know your thoughts in the comments section down below, as it would help others when investing.